Good evening, sir.
Good
Good evening,
evening.
sir.
Good evening, sir.
Good evening.
All of
Good
you,
evening.
good evening, sir.
Good
My
evening, sir.
name is Devi Chandra, IOV Mysore branch. Hello, my dear valued participants. You are all coming from different parts of states. Today is an auspicious day for our valued participants to this webinar. In this connection, I welcome to all participants. I welcome to our chief guest, Shri V.K. Goyal Sahib. He is an honorary General Secretary IOV and MD CEO of IOV RVF. To this webinar he is going to inaugurate. I also welcome to the speaker N.K. Rajkumar and the event organizer T.V. Krishnamurthy and our vice chairman Shri R. Ravi and honorary secretary G. Gopal. I welcome to all participants once again. Thank you one and all. Now I am going to introduce our chief guest Shri V.K. Goyal. I am very happy to introduce our beloved Shri V.K. Goyal Sahib. He is a son of late Shri P.C. Goyal Sahib, founder of Institution of Value last 52 years back. From his vision, IOV is completed 52 years, having more than 30,000 plus life members. Now, V.K. Goyal is the Honorary General Secretary of the prestigious institution. In his spirit, IOV is #1 in India. He is given new shape to Indian Value Journal, spreading knowledge by the different, the digital are also digitalized and available in the website. Government of India during 2007 brings new Companies Act under Section 8 for valuers and valuation. Accordingly, IBBI is formed in 2018. Shri V.K. Goyal Sahib is taking initiation in a higher level and formed IOV Registered Valuer Foundation, an offspring of IOV. IOV RVF is a registered by IBBI as a registered valuer organization with the object to facilitate the valuers by providing 50 hours MEP course for L&B, P&M and securities and finance in getting registered with the IBBI as registered valuer. He is a managing director and chief executive officer for Institution of Valuers Registered Valuer Foundation. He organized first MEP course conducted at Delhi during May 2018, first in India. Then IOV Mysore branch and other IOV branches conducted the MEP courses from his guidance. After COVID-19, he is conducted the courses online regularly. Now, thousands of valuers become registered valuers from IBBI. IOV RVF is also conducting CAP and COP programs regularly. Shri Vinay Goyal Sahib is a member of IVSC Advisory Forum Working Group. In his period, values bill presented to Parliament, hoping during the bill will be passed this year only. Recently, Institutional Membership Forum in the month of June, CRT Foundation registered the institutional membership from Institution of Valuers. During this month, under the guidance of Shri Vinay Goyal, is framing the policy on circle rates in Delhi. Eminent valuers from Delhi registered Delhi region contributed with their valuable inputs for the purpose. His vision is similarly all branches of the capital states should do this job with the help of state governments. Many more things to say his achievements. He is an inspiration for all of us. V.K. Goyal sir is doing hardly for the benefit and happiness of the values fraternity. He is an inspiration for all of us. Thank you, sir. Thank you, one and all. I also introduce speaker of this evening. Today's speaker, Shri N.K. Rajkumar. He is a senior valuer from IOV, Mysore branch. Basically, he is a civil engineer. He secured BE degree, MSc Real Estate Valuation, and MSc Plant and Machinery in distinction. He is also a wealth tax valuer and IBBI registered valuer. He is faculty member of. He is also a faculty member of IOV RVF. He is a main speaker of for IBBI MEP 50 hours courses conducted at Mysore branch. Sri Rajkumar is the author of IBBI exam guide books as per syllabus. He also published real estate valuation, income tax valuation related valuation profession books. In addition, regularly writing articles to Indian Valuer Journal. He got the silver medal for his article at Global Valuers Congress held at Delhi in 2019. He is also doing coaching classes for freshers and repeaters. For his guidance, number of valuers cleared the IBBI exam and become registered valuers. Today, he is delivered the lecture on Income Tax Act of New Rule 2020 and its effect on capital gains. I request you please enrich your knowledge from his lecture in capital gain valuation. Thank you, sir. Thank you. I request Shri V.K. Goyal sir to inaugurate the webinar and deliver your inaugural address. Kindly do it, sir. Thank you, sir.
Thank you, Chandra sahab, and good evening, everyone present here, and thank you for inviting me, and I thank IOV Mysore branch for inviting me as chief guest, and welcome Mr. N.K. Rajkumar, our faculty in IOV RVF and a renowned person in the field of academics in valuation. Today his topic on Income Tax Act and its effect on capital gains in the purview of new rule 2020 is a very vital webinar for all to understand and know how the taxation valuation under the taxation is done. My view is that valuation, we just every time we talk about the valuation, we only talk about banks and banking valuations, but other areas are still to be explored. And I think taxation has a very vital role, as Chandraji has already explained a few much about all such activities of IOV. I would just say that the way IOV has got an opportunity with the Delhi government regarding the revision of policy for circle rates in Delhi may play a very vital role in coming future for all other areas, so that others can also follow suit. And we are finalizing on the report to be handed over to the Delhi government. And we had a very fruitful meeting with the assigned district magistrate and the sub-district magistrate of one of the zones of Delhi who have been assigned for this particular aspect of revision in policy for circle rates. And I put my words in front of them, favoring the valuers that this circle rates should largely be done by the valuers only. There should be the government should be aware that only the valuers can give a real factual picture on the circle rates, because as all are aware that there is a gap between the market rates and the circle rates. And whatever I have observed during my tenure as General Secretary or even as MD of this IOV RBF, the main ailing point for our valuers is the land rates, which are generally not matching, and this mismatch is producing a lot of troubles for them. So my stress is on that. Let us have this report, and then I would like all other branches across, because IOV is fortunate to have branches across the country, and let us make some pool of data around the country from different branches and from for different areas and different states so that our people can really get the access to other areas rates, and comparative analysis and market analysis are done in a much better manner and are not indicted to what is normally being done in such cases. And this is one of the area. And then of course other areas are being like academics under the chairmanship of Shri Nitin Leleji, who is chairman of education and course committee. Mr. Chandra has already told that we have started the institutional membership in IOV, and it is we are inching towards the success. Already we have two institutional members now in of IOV. One is this CRT Foundation, another is a professional company of Mumbai, and in the uh, and the academic our academic committee is looking for and working continuously on producing new courses, the bridging and specialized courses, and very soon you will find some of the courses being launched for the benefit of our existing valuers as well as the new entrants. Why I'm saying in existing valuers is that there are certain areas where some specific specialization or some specific studies are required for the valuers, the existing registered valuers. So if we provide them with the proper academic qualifications for that particular field, like for example, I can quote one: mining in stones and mining. This is just or agriculture. So our valuers who are existing, they can go through those such kind of bridging courses and get access to other areas of the valuation. And let us not sit back and confine ourselves to only bank valuations. Bank valuations will remain and will definitely be in coming times with the if the valuers bill is passed. I think banking valuation scenario is going to change. Whatever today we are seeing is not a very happy situation for our valuers, like asking the indemnity bond or other 70 years of age and all these, when we are contesting these in courts also. But at the same time, if the with the passing of the valuers bill, I believe that all such areas where we are troubled will go away. And similarly, our existing registered values, while IOV RBF today is the largest presence with 1700 plus registered valuers of in all, and we are going ahead. We are surging ahead in all three classes of assets. So it's a happy situation as far as the IOV is concerned. And I believe that, and I also congratulate and thank Mr. N.K. Rajkumar to continuously contribute the Indian Valuer, our journal, continuously. And thanks for that, Rajkumar ji. And I believe that more such articles and better quality and better information, and as of date information like what you have the topic you have chosen is really in topic. So these kind of you know different kind of topics, if you choose and send us the articles, it is most welcome. And all who have gathered here, I would like to also inform that in the IOV RVF, we publish the valuer newsletter. So with this time, I think most of you must be knowing that this time we have dedicated this newsletter to the southern region of India, and we are inviting articles from all across southern area only. It is specifically for southern areas where our so many valuers and so eminent valuers are there. So we expect to gain and to get those articles for that the valuer also. And all these activities like webinars and institutions for more than 50 years, I really, this is really appreciative. And even at the upper level also, then they are fully aware how the institution of valuers had been continuously contributing to the profession of IOV through holding webinar seminars, and now in the coming in this present scenario, adopted webinars as a front runner, and then writing articles. We have now two instruments of for articles, Indian Valuer and the Valuer, and we would very soon be issuing our starting our publications also. We are working on that, and our I thank all our eminent valuers who are contributing towards that. And again, I thank Mr. T.V. Chandra, who has been really a front runner, who has been really a dedicated and dedicated to the cause what IOV had adopted. And he has kept in the southern region, in your Karnataka or even in Kerala. I really applaud. He needs a great applaud for his activities, and at such age also he is so forthright and he's so active, and see he is an innovator, I would say, that how he has immediately converted his seminars into webinars, and so successfully. What the figures have been told to me is amazing. No other place we have received so much of gathering in one webinar, hardly anyway. So I will not take much time because Mr. Rajkumar is quite anxious and eager to talk on his favorite subject. Thanks again to all the participants, and I believe they will be enriched by Rajkumar ji regarding this particular topic of Income Tax Act and its effect on capital gains. Thanks again to all present here, and uh, Chandra Sahab, very thanks to you, and Rajkumar ji, great thanks, and Mr. Krishnamurthy and other officials of IOV Mysore branch and the participants. I wish a good success for this webinar, and I would like to take your leave if you allow me, and thanks for that again. Thank you very much.
Thank you, sir. Thank you. Thank you very much, sir.
Thank you, sir.
Thank you, sir.
Thank you.
Now, Mr. Rajkumar is addressing the gathering.
Yes, good evening, everybody. So thanks for Sri Vinay Goyal ji. He has given a good start, his inaugural words, and the 4 features of IOV programs. They are doing a lot of work in Delhi for the values fraternity. Constantly encouraging the faculty members and speakers, and inspiring us to write the articles and publishing our articles, and given many chances to for MEP presentation, and even for webinars and seminars. The seminars are converted into webinars because of this COVID situation. I think it's already time up, and I will directly go to the topic. And before starting my presentation, I would like to thanks T.V. Chandra sir, 80 years young man, so who is inspiring and constantly encouraging all the valuers, supporting all the valuers, conducting events, seminars, so for his dedicated service. So, and he has given me a chance. Every time he has given me a chance and opportunities to prevent the papers and to for any purpose. So first you remember our name and you will give the first priority to us only for any of the IOV activities. So my special thanks to Chandra sir and Vice Chairman Sri Ravi and also Secretary and all the team members of IOV Mysore branch. So we are constantly supporting and encouraging me to grow as a valued faculty and whatever and whatnot. So with this few introduction words, so and also I would like to welcome all the number of delegates, participants who are participating in today's this special webinar. I would like to because this is a special. So they are on the new rule. So the new rule in income tax under the 2020 has been introduced for the capital gains, and it has got a major effect. It has just changed the total scenario of the valuation of the capital gains valuation, and a lot of people are having the misunderstanding, misconception about this act. And today I would like to articulate the clarity, and I would like to give the clarity and clear interpretation of this new rule.
Hello, Anna. Hello. Ravi sir, ಒಂದು 2 ನಿಮಿಷ ಮಾತಾಡ್ತೀರಿ ಸರ್, ಡಿಸ್ಕನೆಕ್ಟ್ ಆಗಿದೆ, ಮಾತಾಡ್ತಾ ಇರಿ ಸರ್. 2 ನಿಮಿಷ ಮಾತಾಡ್ತಾ ಇರಿ ಸರ್.
ಓಕೆ ಓಕೆ.
ಫೋನ್ ಮಾಡು.
Zoom. Okay.
ವೇಟಿಂಗ್ ರೂಮ್ ಅಡ್ಮಿಟ್ ಕೊಡು. ಸರ್ ಮಾತಾಡಿ ರಾಜ್ಕುಮಾರ್ ಸರ್.
ಸರ್ ಇಲ್ಲ, ಸ್ವಲ್ಪ ಚಾರ್ಜ್ ಹೋಗಿತ್ತು. ಆಯ್ತು ಬ್ಯಾಟ್ರಿ ಲೋ ಆಗಿತ್ತು. ಓಕೆ, ಸಾರಿ ಫಾರ್ ಇನ್ಕನ್ವೀನಿಯನ್ಸ್. ಸರ್ ನೋಡಿ, ಓಕೆನಾ? ಕೇಳಿಸ್ತಾ ಇದೆಯಾ ಕೃಷ್ಣ ಸರ್? ಓಕೆ ಸರ್. ಓಕೆ, sorry for disturbance. So the new amended rule, which is introduced in 2020 under section 55, which is effect from 1/4/2021. So it says that, very simple, in simple few words, just in 3 or 4 lines. So they have made this new rule without any subclass and narrations. So that is what it is creating a lot of confusion among the valuers and accounting people. So that as per this new rule, the fair market value of asset shall not exceed the stamp duty value wherever available of such assets as on 1/4/2001. So this is all about this new rule. But it leads to a lot of confusion and ambiguity among the minds of the valuers, especially doing the valuation of capital gains, and the accounting people. Accounting people are taking the undue advantages of this new rule. So without properly interpreting and understanding the new rule. So it is the job of the technical people, valuers. So doing the valuation for capital gain purpose, whether land, building or land and building, whatever may be the asset, it is purely the job of the 34 of the registered valuers, so not the accounting people. So once if we do the valuation, if we hand over the valuation as an 1/4/2001 new base year, so then they will index and they will do the rest of the things and submit the report to the income tax department. So, but here I would like to articulate and give the clear my opinion about the interpretation of this new rule. So I will give a number of examples and one case study. I brought one case study and then one example also to make you clear about this new rule. And I think by the end of this presentation, all your doubts will be clarified. Any of your doubts and questions, you please post me to my WhatsApp number or my mail. I will answer. And at the end, if the end of the presentation, so if the time permits, I will also answer your queries. So I think at the end of my presentation, there will be no doubts in your minds. So because I will going to explain the entire the new act, and along with this new rule, they will also introduce some 3-4 important tools. I will also explain in the middle of the presentation a new rule. A new 5 years rule is introduced in Section 45 with respect to the joint development agreement, and they are given some exemptions to the owner or the promoter, so not to the developer. So that also I will explain. So that is a good rule. But this new rule is having a lot of confusion, and it is having what I say that. So I don't say that it is not correct. Whatever the government has made this new rule. So in anticipation of getting the proper and more tax for the government. So that is their burden. But I will explain this new rule. So before explaining this new rule, so first I would like to remind because many senior valuers are attending, they know very well what is the capital gains. So capital gain is a gain which arises due to the transfer of during the transfer of an asset. If any asset is held more than 24 months or 2 years, it is treated as a long-term capital gain. As per the new amendment rule 2017-18, the base year has been shifted from 1981. The old base year has been shifted to the new base year. So that is a good work done by the government. And along with that, so they have made the amendment and they brought some more changes. The holding period of the capital gains earlier was 3 years, 36 months. That has been brought down to the 24 months. If any person holds the asset, acquire the asset and hold it for more than 2 years, he is held liable for the long-term capital gain. And if he disposes or if he transfers or sells the asset within 24 months, so then it is a short-term capital gain. It will not attract the capital gain tax. Only they will pay directly 30% income tax. But if any assets held more than 24 months and transferred, whatever the gain they are getting for that capital gain, so one is liable to pay the 20% capital gain tax. Earlier, the capital gain tax for the individuals is 20%, and for the companies it is 30%. For the companies it reduced to 25%, and now they are made equal. Whether it is an individual person or a company, the capital gain tax is uniform and common, 20% for all. So with this, I will explain the actual procedure or the practice, whatever we are doing for the last 20-25 years for the computation of capital gains. In the computation of capital gains over all these days, so what we are doing with the valuers. So we are considering the highest share instances of the market value of the comparable assets in the localities and which are recorded and registered in the concerned local sub-register office as in 2001-2002. Means we are asked to assess the value of a subject property, so acquired prior to the 2001 or after 2001, whatever may be. So if it is acquired prior to the 2001, so we need to assess the fair market value of the asset as in 2001. So how we are assessing the fair market value of the asset as in 2001? So we are finding out, we are making a search on the sale instances of the similar type of properties in the locality from the sub-register office documents, and we are finding out the number of 4 or 5 sale transactions, and among them, so we are selecting the highest unit rate, and we are adopting that highest rate for assessing the fair market value of the subject property in comparison with the comparable sale instances. Then we are not making any comparison with the guideline rate. So we are selecting the highest sale instance rate, and we are adopting that rate to assess the value of the subject property as a fair market value. So that is the procedure before this new act. So what is the effect of this new act? So year afterwards, after the introduction of this new rule 2020, which is effect from 1/4/2021, Means if any assets which are transferred after 1/4/2021, earlier it is 2021 they have told, so but so we can take some chance because so the act is not totally got awareness, and it will any new rule or act into it will take some time, some moratorium period to adjust to accomplish ourselves to the practice. So it's strictly they are made to implement this act from 1/4/2021. So year afterwards, so any assets which are transferred after 1/4/2021, valuers should be very, very careful that we must and should follow this new amended rule. So whatever may be its in effect or whatever may be its problems, but we are bound to follow this new rule because the entire income tax violations is mainly based on the income tax, especially capital gain violations. We should be thorough with the section 45 to section 55, all these 10 sections and subsections. We should be thorough with this section. Then only we can assess the value for the capital gain purpose. So this new rule badly has made the detrimental changes in the process of assessment of the capital gain valuation. Here, the fair market value. So this is what the confusion between the fair market value and the guideline value. So that I'm going to clarify. So in the next slides. So here they simply say that the fair market value shall not exceed the stamp duty or guideline value. Means, so people are misunderstanding that so the fair market value, we are not supposed to work out the fair market value. We are not supposed to assess the fair market value. We can directly adopt the guideline rate as in 2001. No, that is wrong. So I will once again I will go back to the previous slide. Let us read the act once again. So the new provision states that the fair market value of asset shall not exceed the stamp duty value wherever available of such assets as on 1/4/2001. Means first step is we have to work out the fair market value, and you compare that fair market value what you have assessed as in 2001 with the similar sale instances values with the guideline value as in 2001. And if you find that the fair market value what you have assessed is more than the guideline value, then you restrict your fair market value of the subject asset to the guideline value. That is what the new rule says. So not to take the guideline value directly for calculation of the fair market value. So we have to work out the fair market value. We have to assess the fair market value as in 2001. So then you adopt to assess the value of the subject property. So if the fair market value is more than the guideline value as in 2001, then you restrict your fair market value to the guideline value. So I will show with a small example. So I will take up this small example. So this example and one case study. I think these two are enough so to make you understand the effect of this new rule and how to assess the compute the capital gain amount. So suppose if 1,000 square meters of the plot, it's a plot area of 1,000 square meters, make an assumption, and the guideline rate is 1,000 rupees. So just make an assumption as in 2001. So then what are the guideline value? So 1,000 square meters area into 1,000 rupees unit rate per square meter. So 10 lakhs is the value of this plot of 1,000 square meters with the guideline rate of 1,000 rupees. So first step of valuation. And then you have to assess the fair market value. So that is the guideline value. So the procedure is not changed, but they have changed. They have removed they have restricted the fair market value to the guideline value. The procedure is not changed. So then the first step, as usual, we are doing in the past previous days for assessing the fair market value for computation of capital gains is you conduct the same exercise to assess the fair market value of the similar properties as determined through the market investigation and analysis with the proper justifications and with the proper proof of documents. So the nearest actual proof of documents is the sale transactions which are occurred in local SRO office as of 2001. And here in this case, it is the highest rate is 1,200 rupees. That is the fair market value. You apply that rate and assess the fair market value of the subject property. Subject plot is 1,000 square meters into 1,200. So 12 lakhs is the fair market value of your subject plot. Then you compare the fair market value which is assessed with the guideline value. So guideline value is 10 lakhs. The fair market value is 12 lakhs. So the fair market value is found to be higher than the guideline value. So now you restrict your fair market value of the subject property to the guideline value. So in this case, you have to take the lower of the fair market value and guideline value. So lower one is the guideline value. So fair market value is higher than the guideline value. Restrict the guideline fair market value of the subject property to the guideline value of 10 lakhs rupees. So that is the first step. So next, then what about the status of the real sale transactions happened and registered in the sub-registry office? So fair market value has lost its meaning. So this act has defeated the meaning of the fair market value. So the fair market value has lost its meaning and it lost its identity. So the fair market value is denied, and the government wants more and more tax, and they're thinking that the fair market values are registered in the registration office or depend upon the different situations. Sometimes, unfortunately, the people may register the properties for some purpose in some occasions for the higher values, and that is why they're thinking that if the fair market value is more, then the capital gain amount will be less, then the tax to the government will be less. So in whatever, so their intention, anyhow they restricted the fair market value to the guideline value. The second step. In the second step of the assessing the fair computation of capital gains, the first step is you assess the fair market value, compare the guideline value, and if the fair market value is higher than the guideline value, restrict the value of the subject property to the guideline value. So that is the first step. The second step. So second step is you have to verify the acquisition cost of the subject plat. So 1000 square meters plat is acquired in 1999 prior to the 2001. So it is the acquisition cost registered and recorded is 11 lakh rupees. Here it is found to be higher than the guideline value. But as per the second step of procedure, after comparing the assessed fair market value and the actual acquisition cost, and we have to consider the higher value among the assessed value, the first step, and the acquisition cost. Here, the assessed value is restricted to 10 lakhs, whereas the actual real acquisition cost of the subject plat is 11 lakhs. It is the exceptional case. Just I'm giving an example. So then your fair market value is again changed to 11 lakhs, not the 12 lakhs, because 11 lakhs is the actual acquisition cost of the asset. So now I am interpreting like this. Suppose if the pure acquisition cost of the asset itself is higher than the guideline value, then the acquisition cost has to be considered as the fair market value, which is exactly against the provision of this amended rule. So this is one the friction of law. There are two friction of law I found in this new rule. So later on I will explain one more which affects the 50C. So this is suppose the case happens like this, the acquisition cost itself is more than the guideline value, then it is the real value. We have to, as per the procedure, we have to adopt the higher of the assessed value at the acquisition cost. Here in this case, acquisition cost is 11 lakh. So that is the fair market value of the asset. So this all happens sometimes when the introduction of the new rule or any act. So this we call it as a friction of law. So we are bound to adopt the new rule. So because the rule made by the uniformly applicable for the entire India and for the computation of the capital gains. So the friction of law will be there many times. So next I will come to that later on. So in the above case, the subject property acquisition cost is the real value. The acquisition cost of the property which is acquired in 99 before 2001, 2 years back, and it has purchased and acquired and registered in the registration documents for 11 lakh rupees. That is the real value. So here there is no need to obtain the comparative fair market value of sale instances to arrive the fair market value, because the acquisition cost itself is the real value, and the guideline value or the comparative fair market value or hypothetical values and unreal values, whereas the acquisition cost itself is the real value. Hence, here in the above case, the acquisition cost of rupees 11 lakh itself is treated as the fair market value. So this is one phase. So next I will take up one case study. I will try to complete within 1 hour. I think within 7:45 I will try to complete all these things, and I will try to articulate the impact of this new rule, and after the impact of this new rule, how to compute the capital gain. So this is a very simple case study. Mr. Suresh, one person, has acquired a residential property in 95-96 for rupees 85 lakhs. He had done some improvements to the property, some renovations, whatever maybe in 1999 at rupees 1,50,000. Then Mr. Suresh has sold the property on May 2021 for 8 crore. So this is the problem. The plat area has given the data. The plat area is 1,500 square meters. The guideline rate as on 1/4/2001, so which is in that area 9,500 rupees per square meter. And the fair market value assessed with the sale instances is found to be higher unit rate. So that is worked out by the valuer, 12,000 rupees per square meters. So now compute the capital gain and capital gain tax. Let us see how to solve this simple problem as per the new rule. So cost of acquisition in 1995 is 85 lakhs. So that is the data, note on all the data. And year of acquisition is 1995-96. So year of transfer of the property 2021, it is more than 2 years. So capital gain, like it is treated as a long-term capital gain. So we know the cost inflation index for 2001 and 2, that is base year 100 with a new base year, and 2021 it is 301, that is the cost inflation index for the final computation of the capital gains. The fair market rates of the similar properties as determined through the market investigation and analysis by the valuer by comparing the similar shared instances as on 1/4/2001 is the highest rate is found to be 12,000 rupees per square meters. Now let us see as per the new rule how to assess the fair market value. So fair market value of the property as on 1/4/2001, the plat area is 1,500 square meters. And the fair market unit rate is 12,000 rupees. So 1 crore 80 lakhs is the fair market value of the plat. So what we are doing earlier. But the guideline rate of the property is 1,500 to 9,500. So 1 crore 42 lakh 50,000. But as per the new rule, so the fair market value shall not exceed the guideline value. If it exceeds the guideline fair market value, we restrict the value of the subject property to the guideline value. So among 180 and 142.50, so we have to consider the lower guideline rate of the value of the property as on 2001. The land value of the property considered is 1 crore 42 lakh 50,000. That is the first step. So next step, you work out the acquisition cost and improvements before up to the 1/4/2001. So acquisition cost is 85 lakhs. That we cannot change. So that is the actual acquisition cost or historic cost. And in 1999, you spent 1,50,000 for renovation. So total acquisition cost of the asset up to 2001 is 86 lakh 50,000. So you compare this acquisition cost, actual acquisition cost, 86 lakh 50,000 to the value assessed in the step 1, that is 1 crore 42 lakh 50,000. So among this A and B, you select the higher value, the second step of valuation. So here, always in general, the acquisition cost is less than the guideline value. So the acquisition is acquired, is done prior to the 2001. So the acquisition cost is very less because 2001 rates are usually updated with the new rates, and the acquisition cost in 99% of the cases, the acquisition cost is less than the guideline rate. So here, the first step you have to consider, that is the 1 crore 42 lakh 50,000 is the value of the asset. So now work out the indexed cost of acquisition as at 2021. The property is sold in 2021 at 21-22, whatever may be. So 1 crore 42 lakh 50,000 is the cost. So that is the fair market value assessed in the step 1, and step 2 it is confirmed. So 301, that is the cost inflation index as in today, and base value 2,100. So 4 crore 28 lakh 92,500 is the indexed cost of acquisition or fair market value of the asset as on 2021. So the sale consideration amount in 2021 is 8 crores. Hence the capital gain tax is sale value minus the indexed value. So fair value, so sale value is 8 crores, index value is 4 crore 28 lakh 92,000. So capital gain amount, so capital gain is 3 crore 71 lakh 7,000 in this case. So capital gain tax 20% is applicable. So it is 74 lakh 21,000 in the capital gain tax. I think now it is clear how to assess the capital gain amount by applying the new rule. As per the new rule, so this is the procedure. You have to assess the step by step, in the two steps like this. So now I have drawn some inferences on this market value and guideline value. So because this new rule has suppressed and it has defeated the meaning of market value. So market value has lost its meaning. So with this new rule, I would like to say it undermines the very purpose of market value. So this is not correct. But anyhow, so we cannot make comment on the Government Act. So only option is we can file a case in the High Court or Supreme Court and ask the government ask the court to give the directions so that this act is not correct. So this is suppressing the very purpose and meaning of the market value, like that. But the guideline rates are uniformly fixed for the entire area survey number or for the whole area for registration purpose and for collecting the stamp duties. But whereas the market value is the real values, so which are varies from one location to one location, depend upon the potentiality of that property in that locality with the surrounding developments. It is influenced by the surrounding developments. So that is how we are assessing the market value. So the market value varies from property to property in the same locality. But whereas the guideline value is uniformly and commonly fixed for the entire locality, entire area, entire extension, entire survey number. And the guideline values, and that doesn't reveal any influencing factors which affect the individual properties. For all the properties, it commonly the guideline rates are fixed for registration purpose and for collecting the stamp duty. They are the indicative. The word itself says it is the guideline rates, the base rates for registration purpose. The guideline value, so and it will never consider the potentiality of the property. Yes, the market value assessed on the real facts in the market on the real comparable sale instances with the real values rejected and recorded, whereas the guideline value is fixed by the stamp duty authorities for collecting the stamp duty purpose, and they are not the real values. So this is the interpretation. So to substantiate this, I would like to quote one Supreme Court case. So it is a very good case. We are studying in IBB examinations. So why and how the guideline rates are non-relevance to the market value. So they are no way concerned to the market value. Maybe 2 times, 3 times, some banks are foolishly asking, so what is the, why the guideline rates are, the market value is 2 times or 3 times more than the with the justifications. So here, this case clearly gives the guidelines. The Supreme Court under the Javaji Naganathan case in 1994 has given a clear verdict. So like this, the basic valuation register prepared for the purpose of collecting the stamp duty means the guideline values have no statutory base or force. It cannot be the foundation to determine the market value mentioned therein. The evidences, because it lack of the evidences on the bona fide sales, the bona fide sales are the actual sales which are occurred in the open market between the prudent willing buyer and willing seller, and the land is acquired, the property is acquired for the true fair real market values by considering the advantages and disadvantages of properties. So, and they are the real sale transactions are the real values. And the guideline value can never be a market value, and it has no relevance to the market value. So when such is the verdict, and this new rule, so is clearly against this new verdict, and it defeated the very purpose and meaning of the fair market value. So that is why there is a lot of confusion among the accounting people and the valuers, and they're directly adopting the guideline rates. No, you have to work out the fair market value, assess the fair market value as on 2001, then compare with the guideline value. Then you finally take the decision to work out in the first step. Then you compare the acquisition cost and the assessed fair market value. Finally, you arrive the indexed cost of acquisition as on 2001 or the fair market value, assess the fair market of the subject property as on 2001. Then by applying the cost inflation index, we can assess the compute the capital gain amount. So this is my opinion. This is my opinion. This is my personal opinion. So the different persons at different values are having the different opinion or they are having a different interpretation of the law, but this is my opinion. So this, as per my opinion, so this new provision is basically against the law of natural justice. Whatever may be the new rule, that is why I told in the beginning, it leads to the friction of law. It leads to a lot of ambiguity and complications. So it is against the law of natural justice. Because as per the provision of the income tax or for any purpose, any statutory purpose, the SSC has given all the options. So to prove its value among in the two or three different methods or two or different ways, and which method or which method is favorable or which value is favorable to the client, so shall be considered for a tax purpose. So that provision is there in the income tax, and for that also there is one more Supreme Court judgment is there. So, but this new rule has defeated this, and it affects the law of natural justice, and it denies this amendment, denied the market value. So only because of getting the more tax benefit to the government. So this is my opinion. So it is against the law of natural justice, and it created the friction of law, and it is defeated the purpose of market value. So the first part, I think I have completed the first part. I will go to the second part. So I might take another 15 minutes or 20 minutes to complete this. So this is also very important. Here I will come to the conclusion, and so may give you clarity of understanding this new rule again. And one more provision they have made to the section 45. They have got a new 5-year rule. So that is a good rule, and that is beneficial to the landowners and promoters. That I will explain in the next slide. So now, so according to this new provision, so at present, so the assessee or the seller has no option to assess the fair market value. If the fair market value registered or the share instances which are assessed as in 2001, if they are found more than the guideline value, we have no option. We are bound to restrict the fair market value of the subject property to the guideline value. No option. So this new rule has undoubtedly created the detrimental effect on the computation of capital gains as in 2001, and creates the huge tax burden to the aware SSC, where the government is much more benefited to the NST SCG tax benefits, but the assessees are overburdened with the tax. So this is my personal opinion. I don't know how long this rule stands, and the government may continue, how long it may continue, unless and until it is modified. We are bound to follow this new rule. So assessees or the valuers or the sellers have no option. So this is all my opinion and interpretation about the that new rule. So next I will take up this the new provision of Rule 5A under the section 45. So section 45 deals with the computation of the capital gains. That is the first section in the computation of capital gains. Section 45. So what are all the assets which comes under the capital gain purview? So section 45. Section 48, the mode of computation of the capital gains and methods. So there are different sections which have all these new rules and provisions, and all the section 45 to section 55 are well explained with the case studies and examples in my book, in my new revised tax valuation books. So just I will take up this, just I will try to explain this new rule, very important for the values, especially in assessing the value under the joint development agreement. When they changed the new base rule, that new amendment, they made, and the government made the amendment in 2017 and 18, and shifted the base year from 1981 to 2001. So along with that, so they have brought one more change, that earlier days, the joint under any joint development agreement, the developers are exempted from the capital gain tax. They are running the project, so they are conducting the project, they are developing the project, and they are completing the project and selling the developed properties in the 3 years, 4 years, or 5 years. And so these are all they are free from the capital gain tax. So they are brought under the capital gain tax, so under the section 45 in the new amended 2017-18, and now so they have made give one more exemption to the owners or the promoters. So and this new rule 5A under section 45, which is recently introduced, effective 1/4/2021, is not gives any benefit relaxation to the developers. This is especially made to give the relaxation to the owners, to the promoters, to minimize the hardship faced by the owners. The subsection 5A is introduced, and as per this, so if any owner enters into joint development agreement, and if the agreement is specific agreement, specified agreement means registered agreement. If it's unregistered agreement, then this entire Rule 5A and 45 is not applicable. Only if the agreement is specified agreement, means registered agreement, then it is applicable, because many developers in 90% of the cases, they are not going to register the joint development agreement. They are simply making the unregistered joint development agreement, completing the project, handing over the developer portion 50% to 60% as per the agreement to the owners, and remaining they will sell it on the GPA basis, and the entire tax burden will be transferred to the owners, the innocent landlords. So to avoid this, they brought the under this section the developers also to the capital gains. If the developers complete the project within 2 years and complete the entire process within 2 years, they are not comes under the capital gain tax. If the development complete the development, if the project runs more than 2 years, and if they transfer these properties either to a developer or they sell their own portion of the developed property, then the developers are held liable for the capital gain tax if the project is not completed within 24 months. So, but this 5A rule is specially applicable for the owners. So, what it says? So, once if the project is completed, and after obtaining the completion certificate from the competent authority or the concerned authorities, the developer is transferring the agreed portion of the developed property to the owner, 50% or 55% or 60%, whatever may be, to the owner. Then, once the owner is not doing any investment, so owner is simply handed over the possession of his immovable property, land, to the developer, and they have not made any investment, but in turn, as per joint development agreement, so he is getting some developer portion, so he is transferred to the owner, so which triggers the capital gain tax for both for the owner and for the developer. But here under this 5 rule, the owner has given exemption that once if he get the developer share of 50%, whether he can sell in the open market or he can keep it for his own purpose. But if he's getting after the joint agreement, the holding period is 2 years. If the holding period runs more than 2 years, means the date of agreement to the date of completion crosses more than 2 years, then owner is after getting the developer portion of his share, owner is liable for the capital gain tax. In such case, so we have to assess the value of this developer portion of the owner's share with the present stamp duty value or the guideline value, and work out the capital gain tax for the owner minus the present stamp duty value. Say he is getting 10,000 square feet of land. I will give a small example. 10,000 square feet of land has been transferred under the joint development agreement to any developer, and is getting 50% of his share of the developed flats, say 5,000 square feet. So 5,000 square feet after 2 years is getting, after the obtaining completion certificate. So the developer is transferring even without obtaining completion certificate. After the completion of the project, if it is transferred to the owner, and if the holding period exceeds 2 years from the date of agreement, then the owner is held liable for the capital gain tax. In such case, how to assess the capital gain tax for the owner's share? So owner is getting 5,000 square feet, and the today's present stamp duty value guideline rate is say 4,000 rupees composite unit rate selling rate in that area. So 5,000 into 4,000, 2 crores. So 2 crores is the value of the developer portion of share of the owner, and in that you would deduct the indexed value of the land. So he has acquired the land maybe 5 years or 10 years back. You work out the indexed value of the land as on today, or work out the indexed value of the land as on 2001. So bring it to the indexed value of land to the today's value. So the value of the developer portion of the land, say 5,000 square feet of ready flats for his share into 4,000 square feet, 2 crores, minus say suppose 1 crore 50 lakhs is the indexed value of the land. So 50 lakhs is the value capital gain amount for the owner. Whether he sells this developer part, or whether he keeps it for own use, or if he sells after 2 or 3 years. But at present, as soon as it transferred its rights, developer portion, he is liable to pay 50 lakhs capital gain amount, means 20% of the tax, means 10 lakhs is liable to pay the capital gain tax. And in addition to this, if he has received any deposit amount, in addition to the developer portion of the flats from the developer, he is also liable to pay the capital gain tax on that consideration amount or advance amount or the deposit amount received from the developer. So this is the provision made. But whereas for the developers, so you have to work out the cost of the project and deduct the value of the developer portion, which is transferred to the owner, and the entire cost of project. So the owner, the developer is held liable for the capital gain tax because he is not having any land, he is not making any investment on the land. He is getting the vacant land under the joint land rights under the joint development agreement from the owner, and is developing the project, and is giving back the agreed share of the developer part to the owner, and remaining he is enjoying and he is selling. He can sell at any point of time, but if the project exceeds the 2 years, he is also liable to pay the capital gain tax. He has not given any exemption. So his value has to be assessed on the actual cost of construction of the project. You have to assess the actual cost of construction project. So deduct the owner's share, and for the remaining share value, you have to assess the value for the developers. All these case studies are covered in my book. So this is about the 5A rule. So with this, I think I will take another 5 minutes to complete. So one more thing, what is the effect of this? This is my interpretation. So what is the 50C provision? So there is a 50 under the second rule 50, section 50. So there is a 50C provision for the assessees. Under the 50C, so the assessee can challenge the guideline value, and he can register his property for the value lower than the guideline value. Suppose the guideline is 1,000 rupees, he can register his property for 600, 700 or 800 rupees, and he has to give all the justifications and reasons for rejecting the undervaluations. And the assessing officer of the income tax, immediately if the property is undervalued than the stamp duty value, guideline value, so he will issue a notice under 50C provision to the assessees. But assessee has got all the rights, and he can appeal to the court, to the tribunal or to the court, and he can challenge the guideline value or stamp duty value fixed by the stamp duty authorities that my subject property is having, he has to prove his the value under value of his subject property, not 1,000 rupees, it is 700 rupees, because my property is having a narrow dead end approach. It is having only 10 feet narrow dead end approach. So it's a 20% reduction for that factor, and property is low lying. There are so many factors for individual property, and you can prove its value beyond all the reasonable doubts with the special reasons and justifications. You can engage a valuer, and he can prove its value, and ultimately the authorities will accept that value itself as the market value for the owner. So here in this case, and you will be exempted from the tax. So but this new rule, again, because it says any fair market value, it is over-rejected, overvalued or undervalued, shall be restricted to the guideline value. So the fair market value shall not be more than guideline value. It will also have an adverse effect on the 50C provision. So here I will give an example for this fiction of law. So this registered value for 700 rupees, say the guideline value or the stamp duty value is 1,000 rupees, but here accepted, the authorities have accepted, and it is proven in the court, and this value is 700 rupees below the guideline rate. So this 700 rupees has got registered. That value is the fair market value for that owner for that particular asset. That we call as a stamp duty value. The stamp duty value changes from 1,000 rupees to the 700 rupees for this particular case. It is not applicable for all other general case. So beyond all reasonable doubts, he has to prove his value in case of undervalued assets. And he can dispute the guideline value. He can challenge the guideline value, and he has to prove his value. The undervaluation of this property is genuine and correct for his particular properties. So this provision is made under the income tax for the capital gains 50C provision. Of course, this new rule will also supersede the 50C provision in future. I don't know what will happen. So the experts have to work out on this two issues. So these are all the detrimental effect of this new rule on the computation of capital gains. So this I am bringing to your kind notice, and I have drawn my conclusive opinion. So like this. So hence, the government shall review the new rule, considering the effect and impact of this new rule, so from which is effect from for 2021, and hopefully, government may revise this new rule in tune with the 50C provisions, because the 50C provision, they have not changed the 50C provision. So because it leads to the fiction of law. Under the new rule, it says the fair market value shall not exceed the guideline value. And in case of the acquisition cost, the provision is already there in the second step of assessing the computation of capital gains, the fair market value. So the acquisition cost is higher than the guideline value, then the acquisition cost is the real value. That should be treated as the fair market value. So the new rule is against to that also, and the new rule is defeating the fair meaning of the fair market value. So defeated the fair market value lost its meaning, and it is also against the law of natural justice, and it is also defeating the very purpose of 50C provision, which is the rights given to the assessee under the income tax. So I think so. This all to be taken up in the higher level, and ultimately, I think the court or the high courts or the Supreme Court should intervene and give the proper direction to the government. I think this new rule may not last long for years together. So in a year or two, they may going to modify, they may going to change. But anyhow, it is the duty of the valuer to follow this new rule and assess the computation of capital gains, assess the fair market value in compliance with this new act and new rule, and we have to follow the new provisions. So we have no options until and unless if there is any further modifications are made to this new rule. So this is my interpretation and conclusion about this. I think so that is the end of my presentation. I think to the best of my knowledge and ability, I have delivered the interpretation and the provision of this new rule and its effect to the best of my knowledge. If there are any queries, already time of 7:45. The supporter is already, I have taken a time at exact 1 hour time I have taken. It is on become late night. If you have any queries, any doubts, so please post it on my WhatsApp or send it to my mail. I will try to clarify. I will answer all your doubts. I think many participants are participating, and I think all your doubts are cleared by this presentation. I hope you have well understood the provision of this new rule and how to adopt this new rule and how to assess the value, fair market value, and compute the capital gain tax. So my new book, second revised book on tax valuation, which covers all these provisions of this new rule, the practical case studies, and this is the last month I reviewed this new book, and other two books, one theory book and one MCQ book, which are also newly revised, very useful and successful books for the IBB examinations. If anybody are in need of these books, you please contact me on my WhatsApp or mail ID on my mail, and I will send these books. So with this, I would like to thank the TV Chandra sir for his for giving me this opportunity. And this article is also published in July 2021 in Indian Knowledge Journal. I have taken the contents of the same article. So if you are interested, you can read that article. And if you want to learn and practice as per the new rules provision, so this valuation for taxation, my second revised edition. So book is elaborately discussed on this practical case studies and special case studies, especially the land acquisition, the insurance capital gain tax in case of the insurance claims, and industrial properties and special properties, and joint development, owner share and the developer share. All the case studies are covered in my new tax valuation book, second revised book. So anybody interested, so you can buy and you can practice this book. And other two books are more useful for the IBB examinations. So with this, I would like to thank Sri Chandra sir and his entire team, Mysore branch IOV team, for giving me opportunity and their constant support and encourage. And I'm always grateful to Mysore branch. I'm also the executive council member of the Mysore branch. And year afterwards, we're going to conduct some more and more useful programs in the Mysore branch. So Mysore branch is one of the best and active branch in India. From the past 20 years, under the leadership of Chandra sir, they're conducting very good seminars and very good now the webinars also for the use and of the valuers fraternity and for the use of the valuers. And at the end, I would like to thank the two special persons who are my good friends. One senior valuer, Mr. K. Shekhar K. Soman from Bangalore, and Sri TNC Sridhar, the Joint Commissioner, retired Joint Commissioner, and now practicing as a Advocate Tax Counsel for High Court in Karnataka. So they're always clarifying my doubts pertaining to the tax violations and guiding me for tax violation cases. I'm very grateful to these two persons, very senior and expert valuers, Shekhar Soman from Bangalore and Sri TNC Sridhar sir. And I'm also thankful to my IOV, especially Vinay Goyal sir, who is constantly encouraging us to write the articles and giving support. And at the end, I would like to thank all the participants, so which are attended my webinar today in large numbers with your overwhelming support. So thank you one and all, and wish you all the best. Good day and good night. Thank you, sir. And I would like to thank Krishnamurthy. So, sorry, I've forgotten. So he's a good coordinator. He's one of the best coordinator in India. He's always conducting and coordinating the good events and programs. Without Krishnamurthy, so we cannot conduct any seminars or webinars. So my special thanks go to, I would like to deliver to Krishnamurthy, sir. I never forget. Even I beg pardon if I
Thank you very much,
forget to
sir.
call his name. And thank you and all. Thank you, sir. I think it is time up.
Thank you. Thank you very much, sir. Sir,
Sir.
our Vice Chairman, Mr. Ravi, is vote of thanks, sir.
Vote of
Mr.
thanks.
Ravi is going to give a vote of thanks, sir.
Sir, Ravi,
Yes,
please.
sir. Mr.
Sir,
Ravi
Ravi,
is
sir.
going to give, sir.
Ravi, sir, please. Yeah. Yeah.
ಕನೆಕ್ಟ್ ಆಯ್ತಾ ಸರ್? ಹಾ, ಇಲ್ಲ ಸರ್, ಇನ್ನೂ ಓಪನ್ ಆಗ್ಲಿಲ್ವಲ್ಲ. ನಿಮಗ್
ಸರ್ ಚೆನ್ನ ಸರಿಯಾಗಿ ಕೊಡಿಲ್ಲ, ಇವ್ರು ಕೊಡಿ ಸೆಕ್ರೆಟರಿ.
ಸರ್ ಒಂದ್ ನಿಮಿಷ, ಅದು ಕನೆಕ್ಟ್ ಆಗ್ತಾ ಇಲ್ಲ. ಒಂದ್ ನಿಮಿಷ ಸರ್, ಮಾತಾಡ್ತಾರೆ ಸರ್. ಔಟ್ ಆಫ್ ಥ್ಯಾಂಕ್ಸ್ ಹೇಳ್ಬಿಡ್ತಾರೆ, ಇಬ್ರು ಹೇಳ್ಬಿಡ್ತಾರೆ ಸರ್.
ಓಕೆ ಸರ್, ಫಸ್ಟ್ ಯಾರಾದ್ರೂ ಕೊಡಿ ಸರ್. ಫಸ್ಟ್ ಹಲೋ
ಹಲೋ ಸರ್, ಅವರು ಮಾತಾಡ್ತಾ ಇದ್ದಾರೆ, ಕನೆಕ್ಟ್ ಆಗ್ತಿಲ್ಲ
ಸರ್. ಚೆನ್ನ ಸರಿ ಕೊಡಿ, ಚೆನ್ನ ಸರಿ ಕೊಟ್ಬಿಡಿ ಅಲ್ಲಿ ಯಾರೋ ಒಬ್ರಿಗೆ. ಚೆನ್ನ ಸರಿ ಕೊಡಿ ಸರ್. ಇವ್ರು ಕೊಡಿ, ಸೆಕ್ರೆಟರಿ ಕೊಡಿ ಸರ್. ಸೆಕ್ರೆಟರಿ ಕೊಡಿ ಸರ್ ಅಲ್ಲಿ. ಮೂರು ಜನ ಯಾರೋ ಒಬ್ರಿಗೆ ಹೇಳಿ ಸರ್, ಅಟ್ಲೀಸ್ಟ್ ಎನಿ ಒನ್ ಆಫ್ ತ್ರೀ. ಸರ್ ಕೃಷ್ಣ ಸರ್ ಯಾರಿಲ್ಲ ಸರ್ 3 ದಿನದಲ್ಲಿ. ಅವ್ರು ಎಲ್ಲ ಕನೆಕ್ಟ್ ಒಬ್ಬ ಕನೆಕ್ಟ್ ಆಗ್ತಾ ಇಲ್ಲ. ಫೋಟೋ ತೆಗೆಸಿ ಹೇಳಕ್ಕೆ ಅಂತ 1 ನಿಮಿಷ ಹೇಳ್ತಿದ್ದೆ. ಇಲ್ಲಿ ತಡಿ
ಸರ್ 2 ನಿಮಿಷ ಮಾತಾಡ್ತಾ ಇದ್ದಾರೆ.
ಆಯ್ತು ಹೇಳಿ ಸರ್ ಹೇಳಿ ಆಯ್ತು. ಡೋರ್ ಹಾಕು.
ವೈಸ್ ಚೇರ್ಮನ್ ರವಿ ಅವರು ದಯವಿಟ್ಟು ವೋಟ್ ಆಫ್ ಥ್ಯಾಂಕ್ಸ್ ಹೇಳಿ ಸರ್.
ಸರ್ ರವಿ ಸರ್
ವೈಸ್ ಚೇರ್ಮನ್ ರವಿ ಅವರು ವೋಟ್ ಆಫ್ ಥ್ಯಾಂಕ್ಸ್ ಹೇಳಿ.
Sir, not audible.
Dear members of the
sir. Yes, he can say it. So he can say it, sir.
Okay, our chairman has succeeded in for their efforts to conduct this lecture.
Yes,
Rajkumar for their presentation. Thank you, Rajkumar sir. And I would like to thank all the participants in this lecture program. Once again, on behalf of Institution of Valuers, Mysore,
ಸರ್ ರಾಜ್ಕುಮಾರ್ ಸರ್.
ಹೇಳಿ ಸರ್.
ಹಲೋ ಸರ್, ಕ್ಲೋಸ್ ಮಾಡೋಣ ಸರ್. ಅದು ಯಾಕೆ ಡಿಸ್ಟರ್ಬೆನ್ಸ್ ಆಗ್ತದೆ, ಕನೆಕ್ಟ್ ಆಗ್ತಿಲ್ಲ.
ನೀವು ಹೇಳ್ಕೊಡಿ ಸರ್. Okay, on the behalf of Mysore branch, as a council member, executive council member, I would like to thank one and all. I would like to thank all the participants for your patience hearing and your patience presence for last 1.5 hour. And so we are, and I would like to thank Sri Vinay Goyalji for doing this inauguration and accepting our invitation and accepting to inaugurate this event and deliver this valuable words. And also I would like to thank Chairman of Mysore Branch TV Chandra sir for conducting and arranging this webinar. And I would like to thank the entire Mysore Branch team and for their coordination and support. And Krishnamurthy sir, the good coordinator. And at the end, I would like to thank all the participants. So okay, good night and all the best for all the values. Thank you one and all.
Thank you, sir.
Okay.
Thank you all, sir. Thank you one and all, sir.
No, sir. What are things about Ravinu now? Connect 3 ಜನ ಕುಂತವ್ರೆ.